Have you ever made impulsive decisions when trading stocks, cryptocurrencies, or commodities? Or have you witnessed the emotional roller coaster that many traders go through, from euphoria on winning days to despair on losing ones? Well, my friends, you're not alone. In fact, understanding trading psychology might be the missing piece of the puzzle in your trading journey. In this video, we'll explain trading psychology and why it can make or break your success as a trader. We'll also share practical tips and techniques to help you master your emotions, stay disciplined, and thrive in the dynamic trading world. So, if you're ready to gain a profound understanding of trading psychology and take your trading game to the next level, hit that subscribe button, ring the notification bell, and let's dive right in. Our story begins in the 1970s when a groundbreaking theory emerged that would challenge the very foundations of traditional finance. The efficient market hypothesis then assumed that individuals were rational beings and financial markets were perfectly efficient. But fast forward to the 1970s and enter prospect theory. This theory challenged the notion of rationality and brought biases into the limelight, revealing that human decision-making wasn't as logical as once thought. Then, in the 1990s, came the advent of behavioral finance. Indeed, the psychological aspect of finance is paramount because these influences shape decisions that ultimately impact trading and portfolio performance. So, let's dive in and explore the fascinating world of trading psychology. Trading psychology, simply put, is the study of the psychological and emotional factors that influence traders' decision-making, behavior, and performance in the financial markets. It delves into the impact of emotions, cognitive biases, self-control, discipline, and mental states on trading outcomes. It recognizes that traders aren't robots, but are influenced by various psychological factors, leading to biased thinking, impulsive actions, and sometimes suboptimal decisions. Trading psychology emphasizes self-awareness, emotional regulation, risk management, discipline, and resilience as critical elements for making objective, consistent, and successful trading decisions. To understand trading psychology, one must understand the various biases affecting traders. Biases come in two flavors: cognitive and emotional. Cognitive biases are systematic patterns of deviation from rationality in human thinking and decision-making. They are like subtle glitches in our mental software, often occurring unconsciously, and they can profoundly impact how we perceive information and make choices. In the world of trading, these biases can be exceptionally costly. Let's take a look at some of the common cognitive biases that traders frequently encounter. First up, we have confirmation bias. Confirmation bias is the tendency to seek, interpret, or favor information that confirms our pre-existing beliefs or hypotheses. Next is the illusion of control bias. The illusion of control bias is the belief that individuals have more control over outcomes than they do. Now let's talk about hindsight bias. Hindsight bias is the tendency to perceive past events as more predictable than they were. Moving on to availability bias. Availability bias is the inclination to rely on readily available information or recent experiences when making judgments or decisions. Last but not least, anchoring and adjustment bias. Anchoring and adjustment bias involves relying too heavily on the initial information encountered when making subsequent judgments or estimates. Now you might be wondering, why do these biases matter in trading? These cognitive biases can significantly affect trading decisions and outcomes, leading to less than optimal results. For instance, confirmation bias can lead traders only to consider information supporting their existing views, causing them to miss crucial contradictory data. The illusion of control bias might make traders overestimate their ability to predict market movements, leading to taking on more risk than necessary. Hindsight bias can distort perception, making traders believe they could have predicted market movements accurately after the fact, leading to overconfidence. Availability bias can lead traders to give too much weight to recent market events while overlooking less accessible or historical data that provides a more comprehensive view. Anchoring and adjustment bias can result in traders anchoring their decisions to a specific reference point, like an initial price, and not adjusting their judgments based on new information. So, as traders, it's crucial to recognize these biases and actively work to mitigate their influence on our decision making. Mitigating cognitive biases requires self-awareness and deliberate efforts. On the other hand, we have emotional biases. Emotional biases are the hidden influencers in our trading journey, driven by feelings and moods, often clouding our rational judgment. These emotional biases can be as impactful as cognitive biases in the trading world. Let's dive into some common emotional biases traders frequently encounter. First up, we have loss aversion bias. Loss aversion bias is a tendency to prefer avoiding losses over acquiring gains. It can make traders overly sensitive to potential losses, leading to risk-averse behavior. Next is the overconfidence bias. Overconfidence bias is the propensity to overestimate one's abilities, knowledge, or the accuracy of one's predictions. It can lead to taking on excessive risks or neglecting proper risk management strategies. Now let's talk about self-control bias. Self-control bias refers to individuals and traders' difficulty controlling their impulses and sticking to long-term goals. It can lead to impulsive actions driven by short-term emotions. Moving on to status quo bias. Status quo bias is a tendency to prefer maintaining the current state of affairs or sticking to familiar options. It can make traders resistant to making necessary adjustments to their trading strategies. Last but not least, regret aversion bias. Regret aversion bias involves not taking actions that could lead to regret or remorse, even if those actions may be rational or necessary. It can lead to traders avoiding cutting losses or closing positions. Now, you might be wondering, why do these emotional biases matter in trading? Emotional biases can significantly impact trading decisions, leading to suboptimal outcomes and increased risks. For instance, loss aversion bias can make traders reluctant to cut their losses, leading to holding on to losing positions longer than necessary. Overconfidence bias can lead to an inflated sense of confidence, causing traders to take on excessive risks or neglect risk management strategies. Self-control bias can result in traders deviating from their trading plans and disciplined strategies, succumbing to impulsive actions driven by short-term emotions. Status quo bias can hinder traders from making beneficial adjustments to their trading strategies even when change may be necessary. Regret aversion bias can cause traders to avoid taking necessary actions like cutting losses or closing positions out of fear of regretting their decisions later. So, as traders, it's crucial to recognize these emotional biases and actively work to mitigate their influence on our decision making. Mitigating emotional biases requires self-awareness and a deliberate approach. Develop self-awareness by reflecting on your emotional tendencies and acknowledging their impact on your trading decisions. Set clear trading rules and stick to them. This can help maintain discipline and reduce the influence of impulsive actions. Implement risk management techniques like stop-loss orders or position sizing to protect against emotional decision-making. Seek support and accountability from trusted peers, mentors, or trading communities. Sharing experiences and discussing challenges can help regulate emotions. So, in conclusion, trading psychology is not just an academic concept. It is the essence of successful trading. Understanding the psychology behind trading is crucial because it directly influences your decision-making, discipline, risk management, and overall performance. By addressing and mastering the psychological aspects of trading, you can navigate market volatility, manage risk, and increase your chances of long-term profitability. And that wraps up our journey through trading and investment psychology. If you found this video enlightening and are eager to dive deeper into finance and psychology, remember to check out our other videos. We've got a treasure trove of insights waiting for you. And of course, if you're new here, make sure to hit the subscribe button. Join our community of traders and investors committed to mastering their trading psychology and making informed market decisions. Thank you for joining us today. Check out more videos about the trading styles that broke the stock market and stock fundamentals, the Millionaire's Playbook for Success. These videos will assist you in expanding your understanding of the complexities of fundamentals as you set out on your path toward financial success. See you!